In 1944, a 14-year-old boy from a middle-class family resided with his relatives in Omaha, Nebraska. His father and grandfather were both stockbrokers, working to support the family. However, tragedy struck when his father passed away, leaving the boy heartbroken. Academically, he wasn't very successful and even failed his 10th grade exams. While living with his grandfather, he picked up some basic insights into the stock market, igniting a budding enthusiasm for trading. Despite this newfound interest, he was still too young. Time went by, and when he turned 19, he started trading for the first time. Even at such a young age, he began to make reasonable profits, convinced he had mastered the game of trading. He felt confident that he would soon be able to elevate his family's standard of living. He traded daily, hoping each transaction would lead him to millionaire status. He reinvested everything he earned into subsequent trades, aspiring for even larger profits. But one fateful day, he put all his funds into a single trade, hoping for substantial returns. Unfortunately, this time he suffered a significant loss, wiping out all his money. Not only did he lose his savings, but he also found himself in debt. He had a mere 15 days to repay it. With no other options available, he sold his mother's jewelry to settle the debt. His aspiration to become a trader appeared to be in ruins, leading him to decide to quit trading for good. One day, he noticed people around him selling small packets of everyday goods in grocery stores. He expressed his desire to his mother to pursue a similar venture, but she admonished him to think bigger. A few months later, he resolved to return to trading and relocated to New York. Even though he was initially profitable, a single, misguided trade led him to incur substantial losses once more. This cycle of highs and lows continued. Ultimately, he opted to shift his strategy from trading to long-term investments. In 1956, he invested his savings into 3 different companies. As time progressed, by 1966, his investments had grown a staggering 100 times, transforming his dream of millionaire status into a reality. This boy was none other than Warren Buffett, now recognized as one of the greatest investors of all time. Warren Buffett's story is not an isolated. The stock market is not solely for large investors. Whether it's purchasing toothpaste or acquiring your dream home, the stock market influences your life in ways that may not be immediately apparent. Hence, grasping how the stock market operates is vital. Join us in this audiobook as we delve into the entire narrative of the stock market, from its origins in the United States and Europe to its evolution as a crucial component of the global economy. Since the commercial revolution began, finance and debt management in France experienced rapid growth. Informal banks were established to offer loans for agriculture, but managing these loans proved increasingly challenging. To oversee these debts, banks appointed individuals to handle buying and selling, known as courtiers de change in French, meaning foreign exchange brokers or money brokers. This marked the birth of the broker concept. In the 16th century, during the era of the Spanish Empire, the Dutch aspired for independence. They declared independence in 1581, after which their economy became dependent on Asian and African spices brought by the Portuguese. Yet, as the Spanish Empire expanded its control over Portuguese territories, the Dutch sought direct routes to Asia and Africa to lessen their reliance on Portugal. Discovering new sea routes was fraught with peril, with 1 in 10 ships never returning. However, the Dutch succeeded in finding a new route, albeit at great cost, while simultaneously waging war against the Spanish Empire. To finance this expensive venture, Dutch merchants decided to share the profits from their trading endeavors by pooling their financial resources. Their initiative succeeded, garnering around 6 million guilders, roughly equivalent to $110 million today. To facilitate this process, the Amsterdam Stock Exchange was established, recognized as the world's first stock market. The Dutch East India Company became the first publicly traded company. Motivated by this model, various countries globally began establishing stock exchanges to raise funds. In India, the British East India Company initiated the issuance of bonds and shares to finance its operations. Mumbai has long served as India's primary trading hub, where the Indian stock market began to take shape, starting under the banyan tree near the town hall. Gradually, the number of stockbrokers in Mumbai increased, leading to the founding of the Bombay Stock Exchange. Today, the Bombay Stock Exchange ranks as the 6th largest stock exchange globally, while the NSE holds the 7th position. While we understand the origins of the stock market, the pressing question remains: how does this entire system function? How do thousands of companies get listed on the stock market? And why do millions of individuals buy and sell shares of companies daily? Imagine you own a popular fast food restaurant, XYZ Fast Food, in your community. People from surrounding areas visit your shop, and it becomes quite well known. You consider the possibility of opening branches in those areas too. After saving up and borrowing money from friends and family, you successfully launch a new branch. As more customers flock to your new location, you decide to open additional branches throughout the city, but substantial capital is needed for this. Since your friends and family can't provide sufficient funds, you seek out wealthy individuals, offering them a stake in your business in exchange for their investment. These investors are referred to as angel investors. This process mirrors what you've seen on shows like Shark Tank. With the capital raised, you open branches in prominent city locations, all of which thrive. Your fast food chain's popularity skyrockets, resulting in significant profits. However, you don't intend to stop there. You want to expand throughout the entire country, but you require even more funding, and your current investors can no longer contribute the needed capital. Thus, you decide to raise funds from the public by offering shares of your company in exchange for capital. This process is known as an initial public offering, IPO. Through an IPO, your company can secure substantial funding, facilitating your nationwide expansion. This is how numerous successful companies, including Warren Buffett's Berkshire Hathaway, have flourished over time. Through this avenue, individuals and institutions can invest in businesses, thereby becoming shareholders and receiving a share of the profits. The stock market plays a vital role in this dynamic, enabling companies to raise capital while allowing investors to acquire a portion of a growing enterprise. In summary, comprehending the workings of the stock market is essential for recognizing its significant impact on the global economy. From local ventures like XYZ Fast Food to multinational corporations, the stock market stimulates growth, job creation, and wealth generation. When a company opts to go public via an initial public offering, IPO, it allows ordinary individuals to own a piece of the company. However, this also implies that any events affecting the company, whether positive or negative, will have repercussions on the general public. Before proceeding with an IPO, a company must navigate various steps. The initial step involves hiring an investment banker. The investment banker will assess your company's financial records, operations, and business strategy. preparing all necessary documents. Once this is completed, the company must submit its paperwork to the appropriate regulatory agency, like the Securities and Exchange Commission, SEC, in the United States, which ensures compliance with disclosure and regulatory requirements. The SEC reviews the company's documentation, which should include a comprehensive report detailing the business, its historical performance, financial health, and future projections. Based on this information, the SEC will determine whether the company is suitable for public listing. If everything checks out, you'll receive approval. For instance, let's suppose Warren Buffett's company, Berkshire Hathaway, undergoes this process, ensuring all legal and financial matters are meticulously examined. Upon receiving approval, the company enters the draft red herring prospectus (DRHP) phase. This document contains in-depth information about the company, including its financial performance, intended use of the raised funds, and an analysis of possible risks. It acts as a marketing tool for the IPO to entice potential investors. Once the DRHP is finalized, the subsequent step is to publicize it. You need to market your IPO, ensuring that people know they can now purchase shares of your company. However, one of the greatest challenges lies in setting the price of your shares. If priced excessively high, investors may refrain from buying. Conversely, if priced too low, you could miss out on potential funds. To address this, the company employs a book-building process, establishing a maximum and minimum price range, inviting investors to submit bids within that spectrum. Based on demand, the company can adjust the price to an optimal level. Once the shares are set at a price and the IPO is initiated, individuals who are already aware of your company's achievements, such as regular customers at your restaurant, for instance, if there are 10 individuals looking to sell your shares, but 20 individuals are eager to buy them, the demand for your shares escalates, consequently pushing up the price. On the other hand, if there are more sellers than buyers, the share price will decrease. Various factors, both internal and external, contribute to this dynamic. Internal factors may encompass the quality of your offerings, customer satisfaction, and competitive pricing strategies. External factors, on the other hand, include elements that the company has limited control over, such as technological advancements, changes in regulations, political events, news developments, and economic conditions. For example, if rumors circulate about the company experiencing difficulties, shareholders might sell off their shares, leading to a drop in price. Such speculation is a significant force in the behavior of the stock market, with historical instances like the Harshad Mehta scandal, demonstrating how rumors can influence stock price fluctuations. In contemporary times, indices like the S&P 500 and the Dow Jones Industrial Average monitor the performance of leading corporations, providing investors with a broad perspective on market health. When the S&P 500 shows positive performance, it often indicates that the larger US market is thriving. Grasping the workings of the stock market is vital, but a more profound question persists. Why would I choose to invest my hard-earned money in someone else's enterprise? And if I decide to invest, how can I effectively grow my wealth by participating in the stock market? Let's examine this with an example. Suppose you saved $10,000 in 2015 and intended to buy 10 grams of gold. At that point, the gold price was considerably lower. But by 2024, inflation would mean that same $10,000 would purchase a significantly lesser amount of gold. This depreciation in value is referred to as inflation. In this scenario, it is crucial to protect your wealth from inflation. One method is to invest in commodities like gold, which typically appreciates in value over time. If you had acquired gold in 2015 for $10,000, you could have sold it in 2024 for a much higher price, thus outpacing inflation. Another alternative is to invest in stocks, where you buy shares of a company. Consider Warren Buffett's investment strategy as an example. In the 1960s, he purchased shares in companies like American Express and Coca-Cola. Over time, these companies flourished, and the value of his investments soared. His strategy of acquiring reputable companies and holding on to them long-term has enabled him to amass significant wealth. Thus, if you aim for your savings to grow, investing in stocks can be a formidable method. Provided you make informed choices, just as Warren Buffett does, your investments can appreciate in value, allowing you to build wealth over time. The key lies in identifying promising companies to invest in and then allowing time and the compounding effect to work in your favor. Why do individuals choose to invest in the stock market? How can an average person engage with the stock market? There are predominantly two methods for stock market investment: direct and indirect investment. If you prefer to personally research and thoroughly understand the details of a company before making an investment decision, this is known as direct investment. You take an active role in the process. In contrast, if you are not interested in delving into the technicalities and simply wish to invest your money for reasonable returns, then indirect investment is the better route. This is where mutual funds become relevant. You might have heard of mutual funds. In this case, you trust a group of experts with your funds who possess extensive knowledge of the stock market. These professionals analyze and allocate your investments across various companies. Your fund manager oversees everything, making investments in mutual funds considerably less risky than purchasing individual stocks directly. Now, a pertinent question arises. The stock market has been integral to our lives for over a century or two. So, what has changed in recent times that has sparked such a significant increase in its popularity? The answer can be attributed to digitalization. With the ongoing digital transformation, accessing and trading in the stock market has become considerably easier. Online trading platforms have lowered brokerage fees, making it much more affordable for individuals to participate in the stock market. Nowadays, from the comfort of your home, you can quickly open a demat account on a brokerage app and begin buying or selling shares of any company. The convenience of this digital age has rendered stock market participation much more accessible. A study by Funds India indicates that over the past 2 decades, the Indian stock market has delivered an average annual return of 16%, surpassing all other traditional assets. Moreover, the Nifty 50 benchmark index has outperformed global indices, underscoring the robustness of emerging markets like India. The rise of social media influencers has played a significant role in making the stock market more relatable and comprehensible for the average person. These influencers simplify complex concepts, making stock market investing more accessible to a broader audience. Consequently, a growing number of individuals are entering the market. However, this swift growth has also led to some concerning trends. What if people start treating the stock market like a game of chance? What if they believe they can become millionaires overnight? What if they invest all their savings in the stock market, relying solely on luck, without any analysis or research? Regrettably, this is precisely what is occurring. Reports from SEBI, Securities and Exchange Board of India, reveal that 9 out of 10 individuals are experiencing losses. Between the financial years 2022 to 2024, people lost around 1.8 lakh crore Indian rupees, approximately 24 billion US dollars. Imagine the number of individuals whose entire life savings were wiped out instantaneously. Out of 1 crore investors, 93% faced an average loss of 2 lakh Indian rupees, while only 1% profited over 1 lakh Indian rupees. This data does not even pertain to the types of investing we have been discussing so far. It relates to futures and options trading. The unfortunate truth is that the majority of losses have stemmed from options trading, a highly speculative form of trading. Wealth appears to be transferring from the many to a select few, with substantial price fluctuations occurring in a single day. This situation underscores the extreme volatility and risks associated with such trading practices. So, what is happening? The shift towards options trading indicates that a change in approach may be necessary. While some are realizing short-term gains, many others are facing devastating losses. Given this, a more cautious and informed approach to options trading might be warranted. The stock market can indeed be a potent tool for wealth creation, but only when approached with knowledge, discipline, and patience. Principles that Warren Buffett has consistently advocated